All right, so now that we have understood the overall market structure, how to read market structure, the two types of phases that price moves in, we are now going to be moving on to how we can identify trading opportunities on the higher time frame and develop a higher time frame bias of how we're going to take the trades. So today I'm going to be going over two types of overall markets on the higher time frame. We have ranging markets and we have trending markets. These are the two types of markets that we have. Price is either going to be in a ranging market or a trending market, and every single asset is different. For example, SPY, S&P 500 could be in a trending market, while gold or oil could be in a ranging market. So this varies a lot on asset to asset. So you want to be analyzing this on the asset that you're currently trading and looking to place a trade on. So this is very simple, but ranging markets are markets where price is going obviously between two ranges. So let's draw this out real quick. We can clearly draw this out even for you guys to see. This is a ranging market when price is bouncing up and down, and it's kind of like a massive consolidation in a way. You could consider it a massive consolidation. Of course, there is still consolidation and expansion phases within these big moves on the lower time frame. But overall, it is like massive consolidation and is reversing up and down, ranging between two price points in areas. Now, a trending market is when a market is not doing this and not ranging. So instead of ranging, it is actually breaking new highs and breaking new lows, like we mentioned, market structure on the higher time frame. Now, yes, as you can see, we will have market structure that's built up in between these moves up and down. We will have higher highs, higher lows in between these market moves down. So you definitely want to take into consideration what time frame you are looking at. Every time frame is going to be showing a different story, okay? But today we're going to be looking at the higher time frame, the main time frame we're looking at, overall what market we are in. In a trending market, this is something that it could look like. So let's say, for example, let's say we are in a bullish trending market, okay? Come back up here and we break out these ranges. This would be a trending market. So let's draw these ranges out real quick, actually, to show you guys what I'm showing. So as you guys can see, this is a trending market where we are going in one direction on the higher time frame. This is considered a bullish trend market. The same thing going back down. If we are going back down, it will be considered a bearish trending market. So in this case, we are making higher highs, higher lows on a higher time frame. Keyword higher time frame, the overall big market picture. And what happens during these trending markets is we can still play reversals. And the reason why is because we will still have price bouncing between these zones, these areas of interest. This zone, for example, right here is going to be what we call our demand zone. This is where we have a lot of buying pressure from based on previous historical moves. This is our supply zone where we have a lot of supply. We have a lot of sellers in this area defending this area to push price back down to demand before we break up, depending on what overall trend is. So we will still have ranging markets within these trending markets, but the major key thing we want to focus on is you can see these ranges don't hold for long in trending markets. They typically break after one or two touches on a higher time frame. So what we want to do in ranging or trending markets is we want to be playing with the trend. Overall, in the higher time frame, if we are pushing up bullish, we want to be playing demand zones. We don't want to be playing supply zones. We want in our best interest to avoid supply zones. There are some special situations and setups where you can play supply zones safely, but that's from market intuition. From my experience, I would say that's from market intuition. It's not something you can necessarily teach. So again, we want to be having a bias now in a trending market. We want to have the bias of the trend. So because the trend is bullish, we are breaking through zones. Going up, we are holding demand zones very well and breaking through supply. That is an indication of a bullish trend. So we want to be looking for demand zones to get our entries in. So for example, we would be entering here for buys. We would be entering here targeting the supply, okay? Same thing here. Once we come back here, we will enter and target supply. Very, very simple of how this market typically moves in an ideal situation. The market's not going to move as clean as this, but that is basically the gist and understanding and the logic behind the market, okay? You want to be looking for buys and longs and calls. The reason why is because we know that these supply zones won't hold if we are in a trending bullish market. These supply zones at some point will break out. What does that mean? We have a very high risk reward trade. Look at that. double the typical risk reward trade you would get with the supply zone playing against the overall trend. So as you see, these zones work very, very well and will give us a lot higher risk reward, higher quality probability, and a higher win rate. So why not trade with the higher time frame trend if we are in a trending market? Same thing going back down. If we are in a bearish market, let me delete everything real quick. Let's say we are in a bearish market, okay? We are breaking through demand zones, okay? Not the cleanest chart. We are breaking through demand zones, lower highs, lower lows, market structure. If we're breaking through demand zones, we want to be looking at supply and shorting or playing puts when we're at supply. Areas of supply, areas that we can identify where the sellers are very strong. And look at these risk reward trades. We can have much higher risk reward trades than the typical if we played going against the higher time frame, 1 to 3, 1 to 2-ish versus 1 to 7, 1 to 6. So that is basically the gist of understanding market structure, understanding the higher time frame overall, what type of market we are in. Are we in ranging market or are we in a trending market? In a ranging market, we can play both sides safely. Again, this does depend on each scenario. Each setup is going to be different, but from an overall perspective, we are able to play supply zones and demand zones just as equally with the equal bias. While when we are playing in a trending market, we want to go with the overall trend. Now, let's look at this on the actual chart, okay? On oil here, we are in what? A ranging market. Look at this. We are ranging between these two key areas. Every time price has reached here, we have pushed up. Every time price has reached above here, we have pushed down. Very, very simple concept. Look at where price is at here currently on a higher time frame. If we were looking on a very small time frame, we probably would not have seen this zone at all. We would probably be very confused thinking about what we should be trading here. But when we go on a higher time frame, we are able to identify these areas very nicely. And I like to usually use the 4-hour time frame to identify what market we are in. You can even use daily, and if you're swinging, using the weekly. Okay, so again, we're in a range of market here, meaning we can play both supply and demand equally, depending on what price is. Now, look at here. What do we have here? We have range in market previously on gold or on oil. And then we break out this range, just like consolidation and expansion phases. These ranging markets are like consolidation and expansion on a higher time frame. At some point, we will break out the range, like shown here, and we will pick a direction of price. And that's what happened here. You can think of this as a massive consolidation and massive expansion. Look at this. Now we are not in this area here, we are not in a ranging market. We are now actually in a trending market. We are making higher and highs and higher lows, pushing up. So this is a trending market until we then have a break of structure here internally, forcing us to go back to a bearish trend market. And then once we get into this bearish trend market, look, we come back into a ranging market. This is very simple concepts that you should be practicing and looking for when you're trading. Let's see another example. Let's see if we can find something else. Okay, this is perfect right here. This is perfect. This right here. What do you see here? This is clearly a bearish. Oh gosh. Oh my gosh. This is clearly a bearish trending market. We are making higher highs or lower lows and lower highs. We are currently just continuing pushing down. So what do we mean here? Well, we want to be looking for supply zones. We want to be looking for areas where there's a lot of selling volume, and we literally want to just be shorting at these areas or playing puts at these areas. Very, very simple concept that many people try to overcomplicate. And it's truly not as complicated as you think. Now, of course, we are seeing this in hindsight, but even when we don't see it in this hindsight, you could definitely still play it the way you see it. So looking at it here on a higher time frame, you can see we are able to take very great trades. Okay, let's say stop loss fees. Let's say we have a stop loss above the zone. You can take these great trades right here on a higher time frame. You can be swinging these too. Look, you can swing once you break structure on a higher time frame, pushing up. You can even swing this once you can confirm a break structure with many other confluences. We can swing this, holding all the way down until we finish this full retracement, combining everything we have learned. Everything we have learned. Efficient area of the market. We can push back all the way and hold all the way until we complete the full retracement. See, we are combining everything we are learning into one. Very, very simple stuff. Very, very simple concepts. You just have to practice and be able to identify. The more experience you have trading, the easier and faster you'll be able to identify what type of market we are in. So that is what part of my pre-market analysis that I typically like to do is identify what type of market we are in overall. And this will give me a good bias on what are considered A plus setups and what are considered setups that are a bit more risky. So that is it for this section, and I will see you guys into the next.